Welcome back to Finance First TV. Today, we're embarking on an extensive exploration of the fascinating world of investing. Join us as we delve deep into the intricacies of various investment options, from stocks and bonds to real estate and more. Gain valuable insights into the potential risks and rewards of each investment type, and learn how to build a diversified investment portfolio that aligns with your financial goals and objectives. Stay tuned for an in-depth analysis that will empower you to make informed investment decisions and pave the way for long-term financial success. Before we dive into the content, we want to take a moment to thank you all for being here. We know there are a lot of finance channels out there, so we appreciate you taking the time to be here with us. If you're new to the channel, be sure to hit that subscribe button and turn on notifications for more finance content like this. It's free and you'll never miss an episode. Hey there, fellow investors! In today's video, we're taking a deep dive into the expansive universe of investments, where opportunities abound for growing your wealth and achieving financial freedom. Whether you're a seasoned investor with years of experience or a novice eager to learn, understanding the different types of investments available to you is essential for building a robust investment portfolio. So let's roll up our sleeves and embark on this enlightening journey through the world of investing together. Let's start our exploration with stocks, which represent ownership stakes in publicly traded companies. Investing in stocks can offer the potential for significant capital appreciation over time, fueled by corporate earnings growth and market dynamics. However, stocks also come with inherent risks, such as market volatility, economic downturns, and company-specific factors. It's essential to conduct thorough research, analyze financial statements, and diversify your stock holdings to mitigate risk and enhance returns. Stocks have been a cornerstone of investment portfolios for centuries. By owning shares of a company, investors become partial owners of the business and are entitled to a portion of its profits. Stock prices are influenced by various factors, including company performance, industry trends, economic conditions, and investor sentiment. There are two main types of stocks: common stocks and preferred stocks. Common stocks represent ownership in a company and typically come with voting rights at shareholder meetings. Preferred stocks, on the other hand, offer fixed dividends but usually do not confer voting rights. Investing in stocks offers the potential for significant returns over the long term. Historically, stocks have generated higher returns compared to other asset classes, such as bonds and cash equivalents. However, it's important to note that stocks also come with higher volatility and risk. To succeed in stock investing, it's essential to adopt a disciplined approach and conduct thorough research before making investment decisions. Investors should assess the financial health of companies, analyze industry trends, and consider factors such as competitive positioning and growth prospects. One common strategy for stock investing is to build a diversified portfolio of individual stocks or invest in stock mutual funds or exchange-traded funds, ETFs. Diversification helps spread risk across different companies and industries, reducing the impact of any single investment's performance on the overall portfolio. Overall, stocks can play a valuable role in a well-diversified investment portfolio, providing investors with the potential for long-term capital appreciation and wealth accumulation. Now let's turn our attention to bonds, which are debt securities issued by governments, municipalities, or corporations to raise capital. Investing in bonds provides investors with a fixed income stream in the form of periodic interest payments, along with the return of principal at maturity. Bonds are generally considered less volatile than stocks and offer capital preservation and income generation benefits. However, bond prices may fluctuate in response to changes in interest rates and credit quality, impacting overall returns. Bonds have long been favored by investors seeking income and stability in their investment portfolios. When you invest in bonds, you're essentially lending money to the issuer in exchange for the promise of regular interest payments and the return of your initial investment at maturity. Bonds come in various forms, including government bonds, municipal bonds, corporate bonds, and international bonds. Each type of bond carries its own set of risks and rewards, depending on factors such as credit quality, maturity, and issuer stability. Government bonds, such as U.S. Treasury bonds, are considered among the safest investments because they are backed by the full faith and credit of the government. Municipal bonds are issued by state and local governments to fund public projects and infrastructure and may offer tax advantages for investors. Corporate bonds are issued by companies to raise capital for business expansion, acquisitions, or other purposes. Corporate bonds typically offer higher yields than government bonds, but also carry higher credit risk. Investors should assess the creditworthiness of corporate issuers before investing in their bonds. International bonds provide exposure to foreign markets and currencies and may offer diversification benefits. However, they also come with currency risk and geopolitical factors that can impact returns. bonds can play a valuable role in an investment portfolio, providing income, stability, and diversification benefits. They can serve as a hedge against stock market volatility and help preserve capital during market downturns. When investing in bonds, it's essential to consider factors such as interest rate risk, credit risk, and inflation risk. Investors should also evaluate bond prices, yields, and maturity dates to align their bond investments with their financial goals and risk tolerance. Overall, bonds can be an attractive investment option for income-oriented investors seeking stability and diversification in their portfolios. Next up, we have mutual funds, which pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other securities. Mutual funds offer professional management, diversification benefits, and access to a wide range of asset classes and investment strategies. They come in various types, including equity funds, bond funds, balanced funds, and index funds. While mutual funds provide convenience and diversification, investors should be mindful of fees and expenses, which can erode returns over time. Mutual funds offer investors the opportunity to invest in a professionally managed portfolio of securities, regardless of their level of investment knowledge or experience. By pooling money from multiple investors, mutual funds can achieve greater diversification than individual investors might achieve on their own. This diversification helps spread risk across different asset classes and reduces the impact of any single investment's performance on the overall portfolio. There are several types of mutual funds, each with its own investment objectives and strategies. Equity funds invest primarily in stocks and aim to provide long-term capital appreciation. Bond funds invest in fixed income securities such as government bonds, corporate bonds, and municipal bonds, with the goal of generating income and preserving capital. Balanced funds, also known as asset allocation funds, invest in a mix of stocks and bonds to achieve a balance between growth and income. Index funds aim to replicate the performance of a specific market index, such as the S&P 500, by holding the same securities in the same proportions as the index. When investing in mutual funds, it's essential to consider factors such as fund objectives, investment strategies, performance history, fees, and expenses. Investors should also assess the fund manager's track record and investment philosophy to ensure alignment with their own investment goals and risk tolerance. Mutual funds charge fees and expenses, which can impact overall returns. These fees may include management fees, administrative fees, and 12b-1 fees, marketing and distribution expenses. Investors should carefully review the fund's prospectus and fee schedule to understand the total cost of investing in the fund. Despite the potential drawbacks, mutual funds can be an attractive investment option for investors seeking diversification, professional management, and convenience. By investing in mutual funds, investors can gain exposure to a diversified portfolio of securities and access various asset classes and investment strategies to help achieve their financial goals. Moving on to exchange-traded funds, ETFs, which are similar to mutual funds but trade on stock exchanges like individual stocks. ETFs offer investors the flexibility to buy and sell shares throughout the trading day at market prices. They track various market indexes or invest in specific sectors, asset classes, or investment strategies. ETFs provide diversification benefits, low costs, and tax efficiency, making them popular among investors seeking broad exposure to different markets and asset classes. ETFs have gained popularity in recent years due to their low costs, liquidity, and tax efficiency. Unlike traditional mutual funds, which are bought and sold at the end of the trading day at their net asset value, NAV, ETFs trade on stock exchanges like individual stocks. This intraday trading feature allows investors to buy and sell ETF shares throughout the trading day at market-determined prices, providing greater flexibility and control over their investments. ETFs come in various types, including equity ETFs, bond ETFs, commodity ETFs, and sector ETFs, each offering exposure to different asset classes and investment strategies. Equity ETFs track specific market indexes, such as the S&P 500 or the Nasdaq 100, by holding the same securities in the same proportions as the index. Bond ETFs invest in fixed income securities such as government bonds, corporate bonds, and municipal bonds, providing exposure to different segments of the bond market. One of the key advantages of ETFs is their low expense ratios compared to traditional mutual funds. Since ETFs passively track market indexes, they require minimal management, resulting in lower management fees and expenses. This cost advantage can translate into higher returns for investors over the long term. ETFs also offer tax efficiency thanks to their unique structure. When investors buy or sell shares of an ETF, they do so on the secondary market rather than directly with the fund. As a result, ETFs typically have lower capital gains distributions compared to mutual funds, reducing the tax burden for investors. In addition to their cost and tax advantages, ETFs provide diversification benefits by offering exposure to a wide range of securities within a single investment vehicle. By investing in ETFs, investors can build a diversified portfolio across different asset classes, sectors, and regions, helping to reduce risk and enhance returns. Overall, ETFs can be an attractive investment option for investors seeking low-cost, tax-efficient, and diversified exposure to the financial markets. Whether you're a seasoned investor or just starting out, ETFs offer a convenient way to build a well-diversified investment portfolio tailored to your financial goals and risk tolerance. Our final stop on this investment journey is real estate, which offers a tangible and potentially lucrative investment opportunity. Real estate investments involve purchasing properties or investing in real estate investment trusts, REITs, that own and manage income-generating properties. Real estate offers the potential for appreciation, rental income, and portfolio diversification. However, it requires careful due diligence, property management, and an understanding of market dynamics to succeed. Real estate has long been favored by investors seeking tangible assets and steady cash flow. Unlike stocks and bonds, which are intangible financial assets, real estate investments provide investors with ownership rights to physical properties, such as residential homes, commercial buildings, and land. This tangible aspect of real estate can offer stability and diversification in an investment portfolio, helping to mitigate risk and preserve capital over time. There are several ways to invest in real estate, each with its own set of advantages and considerations. Direct real estate investing involves purchasing physical properties, such as rental homes, apartment buildings, or commercial properties, with the goal of generating rental income and capital appreciation. Direct real estate investing requires active involvement in property management, maintenance, and tenant relations, making it suitable for hands-on investors with the time and expertise to manage properties effectively. Another option for real estate investors is to invest in real estate investment trusts, REITs, which are publicly traded companies that own and manage income-generating properties. REITs offer investors exposure to diversified portfolios of real estate assets, including residential, commercial, industrial, and retail properties. REITs typically distribute a significant portion of their rental income to shareholders in the form of dividends, making them attractive for income-oriented investors. Real estate crowdfunding platforms offer another avenue for investors to access the real estate market without directly owning properties. Crowdfunding platforms allow investors to pool their capital with other investors to fund real estate projects, such as property development, renovation, or acquisition. This investment model provides investors with opportunities to invest in a diversified portfolio of real estate projects with relatively low minimum investment requirements. In addition to direct property ownership, REITs, and real estate crowdfunding, investors can also gain exposure to the real estate market through real estate exchange-traded funds, ETFs, and mutual funds. These investment vehicles invest in shares of publicly traded real estate companies, providing investors with diversified exposure to the real estate sector. Real estate investments offer several potential benefits, including the potential for appreciation, rental income, portfolio diversification, and inflation protection. However, they also come with risks, such as property market fluctuations, tenant vacancies, and property maintenance costs. Before investing in real estate, it's essential to conduct thorough due diligence, assess market conditions, and evaluate investment opportunities based on your financial goals and risk tolerance. Real estate investing requires careful consideration of factors such as location, property type, rental demand, and potential for future growth. Investors should conduct market research, analyze property fundamentals, and assess investment risks before committing capital to real estate ventures. It's essential to have a well-defined investment strategy and exit plan to maximize returns and mitigate risks over the investment horizon. One of the key advantages of real estate investing is its potential for appreciation. Historically, real estate has been a reliable long-term investment, with property values appreciating over time due to factors such as population growth, economic development, and inflation. By investing in high-demand locations with strong fundamentals, investors can benefit from capital appreciation and build wealth over the long term. Rental income is another attractive feature of real estate investing, providing investors with a steady cash flow stream that can supplement other sources of income and cover property expenses. Rental properties generate income through monthly rent payments from tenants, which can help offset mortgage payments, property taxes, insurance, and maintenance costs. By carefully selecting properties with positive cash flow potential, investors can generate consistent rental income and achieve financial independence. Real estate investments offer portfolio diversification benefits by providing exposure to a different asset class with low correlation to traditional financial assets such as stocks and bonds. This diversification can help reduce overall portfolio risk and volatility, especially during periods of market turbulence or economic uncertainty. By incorporating real estate into their investment portfolios, investors can achieve better risk-adjusted returns and improve portfolio resilience over time. Despite its potential benefits, real estate investing also comes with risks that investors should be aware of. Property market fluctuations, tenant vacancies, property maintenance costs, and unforeseen expenses can impact investment returns and require careful risk management. Additionally, real estate investments are relatively illiquid compared to stocks and bonds, making it challenging to sell properties quickly in times of need. Overall, real estate can be a rewarding investment option for investors seeking income, appreciation, and diversification in their investment portfolios. Whether you're interested in direct property ownership, REITs, real estate crowdfunding, or real estate funds, there are plenty of opportunities to get involved in the real estate market and build wealth over time. Congratulations! You've completed an in-depth exploration of various types of investments, from stocks and bonds to real estate and more. By understanding the potential risks and rewards of each investment type and learning how to build a diversified investment portfolio, you're well equipped to navigate the world of investing with confidence and achieve your financial goals. Remember, investing is a journey, not a destination. It requires patience, discipline, and ongoing education to succeed in the long term. Whether you're a seasoned investor or just starting out, there are plenty of opportunities to grow your wealth and secure your financial future through smart investment decisions. Thank you for joining us on this comprehensive journey through the world of investments. Don't forget to subscribe to Finance First TV for more insightful content on personal finance, investing, and wealth building. Until next time, happy investing! Thank you for joining us on this extensive journey through the world of investments. Don't forget to subscribe to Finance First TV for more insightful content on personal finance, investing, and wealth building. Remember, the key to investment success lies in education, diversification, and patience. Click the video on the right to learn about credit score and how you can master yours. Until next time, happy investing!